Welcome back to another episode of the LSCRE Podcast. I've got a mobile home guru here, probably just a real estate guru, but his niche and his lane seemingly at 5210. Jack Martin is, of course, that mobile home route. But Jack, thank you so much for coming on. Jack is the co-founder of his company. Thank you so much for being here.
Well, thank you, Craig, for inviting me. It's a pleasure always to share the great news about mobile home parks with the world.
Yeah, the dwindling number of mobile home parks at that.
That's right.
And I'm sure we're going to get into the thesis and kind of the recession-resistant nature of the space. But Jack, before we get into kind of how you're in the chair today, can you maybe give us a backstory about, how you got into the real estate business, if this is your first career, how you got into the really sexy business of mobile home operations?
Well, to be candid, I would have never in my wildest dreams or nightmares assumed that I would end up where I am.
And make two of us.
So the stereotype of mobile home parks got me as well. So I always viewed them like most people do, which is kind of trailer trash.
NIMBYism.
Yeah, a little NIMBYism. Yeah. So, what it looks like on the outside is not always what it looks like under the hood. So, but yeah, I started out in development, land development, construction, general contracting, all of those kind of things. Then I started flipping houses. This is back circa 2001 through 2010. So about a decade of flipping houses. And we built a small rental portfolio along the way there as well. And then I got into apartments, which is where I thought I was going to retire until I tripped over this thing called mobile home parks. So I still love apartments. I think there's an appropriate space for them. I know that's what you do, Craig. But this niche, it's kind of hard to get into. You have to pry your way into it, especially if you're going to emerge at scale. But it's kind of like my when you find your first love, it's kind of like that.
Well, I'm laughingly and chuckling to myself because what I'm hearing is, when I'm a kid, when I grew up, I want to be a doctor, I want to be a lawyer, I want to be an astronaut, I want to be a baseball player, I want to operate mobile home parks. Said no kid ever. But
right.
Sometimes those boring, unsexy, unfun businesses, and the kind of the nature of them oftentimes have some of the best returns and are great spaces to be in. So when you were doing and collecting your single family business, I should say there, were you acquiring deals in Arizona? What was, kind of the geographical focus there?
Yeah, being an Arizona guy, I mean, we started out flipping houses in like the central Phoenix 1940s through 1950s neighborhoods.
Mm-hmm.
So we were just essentially looking for boarded up vacant homes. That's how I got started in the single family space. I was already a builder, so we were buying land, building spec homes. So that was kind of my day job. But in the evenings, I would drive neighborhoods and look for vacant homes and hunt down the owners and make them an offer. So like that's kind of how I got that single family started.
And was that post.com boom?
Yeah, that was post.com. Yep. So it was pre-internet. Well, I shouldn't say that. It was widely available data at the fingertips of everybody sitting in their bedroom. This was back in the day when you used to have to go down to the county building and pull up the microfiche, if you even know what that is.
I do not. Can you educate the millennial Gen Z of the world, please?
You ever heard of floppy disks?
Oh yeah, of course. You sucker the disk drive right in there. Yeah,
it's kind of like that. So microfiche is this clear kind of plastic see-through vellum that you put into this machine, and then you move the machine around and it shows you all the parcels. It's just a way of taking a lot of data and just shrinking it down into a small medium. But you turn on the light on the microfiche machine and you move that thing around and you find the parcel that you're seeking to find info on, and that's where it was. So in the same way today, you can just go to the county website and you can see all the parcel information. It used to be where you could only access that physically. A lot has changed since then.
Yeah, well, I'm just laughing at myself because I used to be a realtor in the Phoenix Valley, and it's very competitive. Now you're competing against, hedge funds. You're competing against very sophisticated owners here that have been buying probably before your time, during your time, after your time doing that. So there's not a lot of alpha in the residential space really anymore, quite frankly. And that has changed a lot. It's a lot more convenient because now, if you're a realtor, you can create a CMA in 2 seconds. But unfortunately, your value is a little less there in that regard. But now that there's so much more competition there, you really probably don't get screamers like you used to beforehand in the space that you're in, or people find themselves in very unique situations, and they still do today in today's age. But with more buyers and more people pounding on your line, the alpha can get beaten out of transactions, I would assume.
Yeah, I think it's two things there. One is that there's a lot of education on how to do it, especially in the single family space. And two is anybody can do it. So there's not a lot of barrier to entry. Yeah, maybe anybody can't do it well or at scale.
But conceptually,
anybody
anyone
do it.
can wholesale and calling up people. Blind squirrel can find a nut every now and then, right?
That's right.
Yeah.
Yeah.
Yeah. So then you said you got into apartments post, that kind of that phase of your business. I guess just before we get into that, do you still own any of the rentals that you acquired back in the day? Did you cash those out? Did you 1031 exchange them? What did you do with that?
Yeah. So the single family portfolio that I was a part of, I exited that business. So there was some other partners in it that wanted to exit. So we exited those completely. Similarly, with the apartments that we owned, I exited that business. So the desire to go pursue mobile home parks as a single asset wasn't met with a lot of excitement from prior business partners.
I'm really shocked, and that was probably also
Yeah.
back in the day when there was a more stigma there. But also, I guess my question to you would be, when did you get into that mobile space? You said you kind of fell butt backwards into it post apartments. So can you kind of give everyone context as to when you got into that space?
Yeah, bought my first little mobile home park in 2012. So this would be almost 14 years ago.
Oh goodness.
And I thought it was the same thing as mobile home park. Excuse me, as an apartment. You have multiple people living on the same property. The thesis has got to be the same until I owned it. Then I discovered that they were apples and oranges in a lot of different ways. Yeah, there are some still similarities. So maybe you could call them cousins to the apartments. But the thing that stands out the most is the tenants own the homes. So if you buy a mobile home park and you have tenants that you prefer not to have, sorry, they own their homes. Those are your tenants. So it's not like an apartment where you can completely empty it, renovate it, reposition the quality and the community, or let's call it the culture there, and then re-tenant it with a different pool of tenants. When you buy a mobile home park, the tenants you have are the tenants you have. So yeah, there's usually some vacancy or some park-owned inventory that's vacant, or maybe some rentals that can be converted to tenant-owned homes. But largely, the culture of your tenant pool is going to be what it already is.
Understood.
It's really difficult to reshape.
Yeah.
There's a rare exception where if you buy a park that has, just a small amount of tenant-owned inventory, that you could change the entire culture there. But those are really heavy lifting projects.
Yeah. Well, also it sounds like, doing something like that from a opportunity cost perspective, and unless you buy someone out, which, that could happen, that could not, I'm thinking it's probably not worth your while to go into something if you're kind of getting a negative feeling from the jump, I would assume.
Yeah, I think what separates, if you think about apartments, most people are familiar with class A, B, C, D in apartments.
No one really says D, by the way. It's just, C.
Oh, C minus.
Yeah.
Yeah.
There's
Yeah.
no D really in the space, or at least no one would tout their property as that.
Oh, trust me, I've owned D class apartments.
Yeah. Well, you admit it, at least others don't.
Yeah, that's the neighborhood. A D class apartment to me is just a C minus apartment in a
worse area.
A really difficult neighborhood.
Sure.
Right? So in the mobile home park business, they rate mobile home parks on a 1 to 5 star scale. 1 star is like the class A, and then 5 star is like the class D. We'll call it class F. But yeah, you wouldn't want to go to a 1-star park or mobile home park in a tough neighborhood at night.
No.
So we don't buy those. But that's the stereotype. Those are the ones that are on TV. That's where the cops show up. I mean, that's where all of the drama occurs. And that's also where, if you're looking for anything illegal, that's where you'll find it. Same with the D-class apartment. I mean, that's just the culture there, right?
Right. Even C
So,
right now, too, particularly. I would say C right now with all the new stock coming online, people are trading up in quality and stuff. So you're seeing game-ridden properties now, even in the C world,
yeah.
that might not have been there beforehand.
Yeah. So I think the opportunity, when we got started, we cut our teeth on what would be the C minus class, call it 2-star mobile home parks, where they weren't really dangerous, but they weren't of high quality. So it's just affordable housing. That's all it was. I liked the 2 and 3-star space, which is a little bit more like B and C, like C plus, call it, where it's actually really good quality real estate that you'd want to own for a long time. So the stereotype starts to disappear the closer you get to a 1-star park. But 2 and 3-star parks are typically like more associated with like a manufactured housing subdivision.
Yeah. So
instead of being a mobile home park.
yeah, so let's kind of, just for those who maybe are not as privy to the mobile home space, because there is some nuances there, right? To you mentioned, some of them are tenant owned, some of them are not tenant owned. Holistically, can you walk and educate the audience through, kind of the types of mobile home opportunities there are from A and B, I guess? Or is there two options? You said some of it are tenant owned, some of them are not. So can you kind of walk through what both those options, I guess, look like?
There's way too many. I mean, there's a lot of nuance there, but generally there's two different models. So most professional owners, certainly those who intend to reposition them and add agency debt to them, are going to focus on the tenant-owned model, meaning when it's done, I want to own the real estate, but I don't own any of the homes. The homes are owned by the tenants. That's the most stable version of a mobile home park. When they're homeowners, they don't move, or they rarely ever do. And even if they do move, they sell their home to the next tenant owner who pays me the lot rent for the space that the home sits on. So very little volatility in the mobile home park business if it's the tenant-based model, or the tenant-owned model. When you go with the park-owned model, which is now I buy all these homes and I'm renting them. Tenants don't own anything except the furniture, and they're renting space from me. Now I essentially have an apartment. So I'm doing what you're doing. The challenge that you have with mobile homes, at least, intelligent operators will share this perspective. If you have an apartment, you generally have 4 walls, exterior walls, and you have 1 roof, generally. And then all the other walls and roofs are within that structure, so that your maintenance and repairs is relatively sheltered from a lot of exposure. Whereas if you have a whole mobile home park filled with brand new mobile homes, you have 4 walls on every home and a roof on every home. And then you have landscaping between every home. Like, all of these things start to work against you with respect to economies of scale. Whereas they work in favor of the tenant. They want to have their own place with no neighbors on the other side of the wall. They want to have their own parking space in front of their home. They want to be able to walk around their home without bumping into the neighbor, and kind of have something that represents their own lot, right? Or their own spot where their home sits. So I don't believe that mobile home parks are designed to be a rental product, but there are owners who do it. They put a really robust maintenance staff on site, and they rent out mobile homes. And, the experience for the resident is similar. They don't have somebody above them, below them, or beside them. But I think the maintenance expense can start to eat against you or work against you. And that's why we don't do that.
Understandable. So when it comes to, I guess, an acquisition that you would do it from your probably perspective where it's tenant owned, I would imagine the experience of the tenants having obviously ownership there probably enhances and makes it more easy to manage. Is that a fair assumption?
Yeah, because your expenses are going to dramatically go down. So if you think about the difference in just kind of mentally between somebody who's renting versus somebody who's purchasing, the renter views their decision as a temporary housing decision, whereas the buyer views it as a permanent housing decision. So just the way that they think causes them to take ownership. So when tenants buy a home in one of my parks, they start to tell their friends, hey, you should come over and check out my park. Like they view that park as their park. It's
Probably
their
prideful
community.
as well.
Yeah, these are all my friends and they also own homes here and this is our community. So there is a lot of pride of ownership that emerges. They typically tend to take care of their space in a greater fashion than they would if they were just renting.
Understand. And with that said, would you almost say to a certain extent that when it is fully tenant owned, that it's similar to a triple net real estate investment in some respects?
Yeah, you could that correlation makes sense. So we take care of common areas, landscaping, lighting, roads, things like that. And everything else is on the tenant.
Gotcha. So I guess, how does one kind of value add or kind of take advantage of a marketplace option in that kind of situation? Are you looking for places that are not fully optimized, where there may be some transitions there, or there's some lots that aren't, used, I guess? Maybe could you walk us through what your typical transaction would look like or opportunity would look like if you had, if you want to go through a couple of examples of past deals that you've done and how you've been able to optimize them?
Yeah, so first of all, the opportunities that exist out there in mobile home parks are going to be a wider spectrum of opportunities than what I'm about to share, particularly because size is one of the primary considerations for us, and most mobile home parks to us are too small. So I think anything under 100 lots is most likely too small for us,
Yep,
at
kind of
least the
mom
way
and
that we
pop
want it.
space, would you say?
Yeah, but mom and pops built this space. So like we're talking to owners of mom and pop owners who have a single park. They've owned it for 40 years. Maybe grandpa built it. Now dad owns it. And it's 400 or 500 lots. So like the mom and pop part of this business is a little bit unique, or it's a little different than it is in other asset classes, primarily because mobile home parks, you can't build them anymore.
Yeah.
Well, that's not fair. You can. It's extremely rare that they get built
It's
anymore.
wildly unique, and in fact, mostly, oftentimes you see them get transitioned, and we'll talk about the thesis there coming up. But
Yeah.
staying on the course with regard to kind of what you're looking to acquire, and I probably got a tangent there, but what are kind
That's
of
fine.
your transactions typically looking like? Maybe if you go through the last couple of them for you personally,
Yes,
not just industry wide.
yeah. So for me personally, I'm really not interested in looking at a deal unless it's in a market where the median home values are above 300 grand. That's because selling a brand new manufactured home inside of a community is typically around 100 grand. And if that delta is not a couple $100,000, it becomes difficult to sell homes at scale. So even if I'm buying 100% occupied property, well, what if there's a natural disaster and now it's 50% occupied? Like I still have to go through executing on filling up those spaces with new homes, right? So to me, that's the most important thing. Secondarily, it would be the location within the market. So I want to be in a location where it's safe, affordable housing in a good neighborhood with decent schools. And it's not the most inexpensive housing in the market because it's in an industrial neighborhood where it's a place you wouldn't want to go at night. Is location within the market is really important to me. And then on top of that, I'm looking for quality. So to me, 3-star quality or better means it has paved streets. Typically it has concrete ribbons or sidewalks. The density is not going to be super tight. So, maximum 8 to 10 homes per acre so that people actually have room in between their homes. I like city water, city sewer, but I'm not opposed to some private utilities if there's redundancy available and if they're of decent quality. Infrastructure is going to matter. So, there's some deal killers on the infrastructure side. So, I'm looking for something that's financeable with agency debt. So, and typically, agency is pretty picky. For your listeners, that's Freddie Fannie.
It's the only debt we use as well, to your point.
It's the best debt. It's the biggest pain in the butt to get it and to service it, but it's going to come with the best terms. So if your property's quality doesn't meet minimum standards, you don't have paved parking surfaces, there's a lot of those kind of things that we'll look for, because if we can't get agency debt, even if we got attractive seller financing on the purchase, the takeout in the future is still agency. So it's our intention to buy properties of that kind of quality. And then we're looking for underperformance in some area. Typically, non-professionally managed parks are going to have a handful of opportunities to improve income, handful of opportunities to improve expenses, and then typically there's vacancy. So that's the hardest thing to do in this business, is to solve the vacancy. And I'm not talking about vacant units that are already there. I'm talking about vacant lots. There's no home there. That becomes the most expensive and the biggest wrestling match in the industry. So if you can get good at infill, it'll expand the number of parks that you could look at acquiring.
Very good. And then let's talk about kind of just rough numbers that you're looking at, going in cap rates, stuff like that on deals that you're seeing, because that can vary from location to location. But, typically speaking, what are kind of the cap rates that you're seeing, kind of the yield plays, the cash on cash, projected returns, things like that? What does that usually look like in your space? Because that to me is, obviously everything varies on a risk adjusted basis and asset class adjusted, right?
Yeah. Well, before we get into that, let me back up, because 14 years ago, when I got into the mobile home park business, it used to be that if you just looked at what was the cap rate for, let's call it a strong B-class apartment in that market, if you add about 200 basis points, that's your cap rate for the mobile home park in the same neighborhood of similar quality. Now that relationship has flipped. So, like, for example, we're both here in Arizona. What would you say a decent quality kind of C plus, B minus apartment cap rate would be in today's market?
Gosh, I'm not too fluent in the Arizona market yet, but I would say for like B plus or B minus, C plus, you're going to have somewhere between a 5.5 to a 6 cap, I would imagine, in that neighborhood.
Yeah, let's call it 6.
Yeah,
let's call it 6. I think you're right. And then you look at the mobile home parks of similar quality that are trading. They're trading in the 3s and 4s.
That's disgusting.
I know. That's where they trade. But this probably fast forward to your thesis. And we'll not fast forward there yet. It's a scarcity play. So the reason why you see the demand in this asset class that's not present in other asset classes is because it's shrinking. So you have institutional players, the Blackstones, the Carlyles, the large institutional players that are coming in and buying stabilized assets as both a coupon that they know will grow over time, but also as a covered land play. So 30 years from now, the land's worth more than the real estate, and that becomes a candidate for redevelopment. So that's the kind of key component that's different than what you have if you're just analyzing kind of simple metrics on another commercial real estate asset class. Mobile home parks are super unique that way. With that said, we see that will fluctuate. I mean, if you go to some more tertiary markets, call it in the Midwest, you might see cap rates in that market, 200 basis points higher than that. So somewhere around 6. For decent quality, 3-star mobile home parks. To us, the going in cap rate is a little bit less important than what we can do to it. So if we're buying a turnaround, there's a project in Mesa that we bought. We paid a 2.9 something. It was a sub 3 cap on real in place numbers day one. Today, that's probably a 10 cap.
Well, it's all about yield. Yeah. The
Yeah,
yield on cost is the more important thing because, if you get a deal that half the units are down, well, sure, technically, it's a two whatever, but the
yeah,
lift play could be very easy to solve for there, to your point.
yeah. So I think what matters the most is this is probably healthy for your audience is to understand what the true exit cap rate should be because that's the lever. I mean, you can't eat equity. You can't eat, proposed equity that's grown on a cap rate 7 years from now.
And
You could eat cash
pie in the
flow.
sky, yeah, pie in the sky,
That's right.
cap rate
Yeah.
compression, things of that nature is very tough. And quite frankly, that's the hardest part of the mobile home business, to my knowledge, is just understanding how to simulate the exit there.
Yeah. Yeah. So I think what's more important, and this is kind of generally the lens that we look at, I want to see a coupon, in the 2 to 4% range year one. I want to see that grow to, 10% in year seven. And this assumes not replacing any debt. We're just going to use acquisition debt and we're going to operate the property. So if I can't grow from a 2 to 4% coupon to a call it 8 to 10% coupon, that starts to become a little bit there. There needs to be a compelling reason why. So it better be a trophy asset in a trophy location or something of that nature. If I can't do that, I'd like to see at least half of the yield over the initial 7 years come from the cash flow. I don't want to see just a little bit from cash flow and the rest of it is all a cap rate lever.
Well, I mean, quite
You know,
frankly, on a risk adjusted basis, you're probably better off investing into multifamily or something else if that's what you're doing there, because
right.
frankly, those are just more core when you talk about institutional equity flows. And obviously, that's starting to kind of trickle in a little bit more to your space. But now that office is out of the picture, residential and where you live has never been more important. So, multi industrial things of that nature is kind of where those capital buckets are flowing into. But on a risk adjusted basis right now as well, if you're seeing that, it's almost silly to be in the mobile home park with rare exception, if that's what you're saying.
Yeah. 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 So if you're going to buy a deal that doesn't even produce a cap rate above the agency debt rate in year seven, that's probably not a deal.
No.
And there better be a really compelling reason why if it is.
Yeah. So you're basically trying to get to positive leverage, by, year two is kind of what I'm hearing there. And then obviously trying to work up from there, which obviously makes a lot of sense on your perspective. How have you seen, let's just get into the strategy and the thesis behind the space, and then we'll talk about kind of the trends and shifts. But obviously the scarcity factor is one thing, but if you were talking to, someone who just graduated college, who doesn't know anything about real estate, could you explain in the pretty simple, digestible terms how you would break down, why mobile home parks?
Yeah, I think there's probably two things that separate mobile home parks from, well, maybe there's three. And if you look at it through the lens of why do I want to be the operator, but more importantly, if I'm an LP, why do I want to allocate to mobile home parks? Because that's the driver. I mean, all of the demand that exists from institutional capital really comes through the lens of if I'm an LP, why do I want to allocate to this space?
Mm-hmm.
That changed a little bit this year when the one big beautiful bill brought bonus depreciation back to 100%. So one of the things that dramatically separates mobile home parks from other investment asset classes is that you can get, if you get the right deal and use agency debt, you can get more depreciation, or for your audience, passive losses on your K1 than you invested in capital. So if you invest $1, you potentially could get $1.50 or $2 back in passive losses, which you can't do in most asset classes. So the tax advantages of mobile home parks they're substantial. Even if you did a vanilla deal with seller financing, you're still going to get dollar for dollar coverage with your passive losses. So that's probably the standout. But if I ask my large check writers, let's call it everybody who writes checks of $1 million or more, like what are your top 3 reasons why you invest in mobile home parks? The first one is that they believe they will not be exposed to loss of capital. The stability of the asset class, and this comes from the tenant ownership, causes them to be comfortable that even if the worst conditions, call it 2008 8, 9, 10, and 11 showed up again, we wouldn't lose any of our money. So that's number one. Two, the tax advantages that we just talked about are more valuable than the yield.
Yeah, for a lot of people who are not aware of this, since it's mostly, equipment, it's not kind of rendered the same of a multifamily deal. Car washes and mobile home parks are off the charts for a depreciation perspective, oftentimes actually more than 1-to-1.
Yeah. So RV parks would qualify there too. I think that the volatility that exists in RV parks would cause an LP to answer the question differently. I don't know how stable car washes are.
I think I would never touch either of those. I wouldn't touch RV. I would consider mobile home. I wouldn't consider RV or car washes. I just don't think it would make sense for myself. I'd buy homes or be in multifamily and be in the residential space because you can always create a car wash, right? So it's just kind of tough.
Yeah. And I think, and then the final thing is, it can deliver a pretty healthy coupon. So particularly call it after your initial ownership term and you're ready to either exit or refinance and return capital and keep the coupon indefinitely, which is really what we like to do. That coupon is actually sizable and it tends to go in the right direction. So you don't experience the volatility in occupancy that you would otherwise experience, like with economic volatility. So, I mean, our lot rent during COVID, we collected 100%. We didn't have the volatility that other asset classes experienced. So it's just really unique.
That's awesome. I guess, with that said, there's been a ton of shifts within the space and business. Can you maybe walk us through, I guess, what you're looking for? Are you even buying right now? What's going on with you in that regard?
We're still buying, but we're really picky. So because I want to take the approach, Craig, that I want to take maximum bonus depreciation in year one. I want to reposition the asset in years, 3 to 5 so that I can refinance and return capital. And then I want to keep the asset indefinitely and not be exposed to recapture or capital gains. I just want to keep coupons forever. Well, not forever, but let's call it indefinitely. Because of that, I'm picky. It's like dating. I'm going to be married to this mobile home park for a decade at least. I want to love them. I don't want to like them. I want to love them. So I'm probably a little bit more picky than other operators that are just turning real estate. I'm intending to hold these long term. So I turn over a lot of rocks. I look at 3 to 5 deals a week, meaningfully probably 10 to 12 a month. And we're excited if we buy 3 or 4 a year. So there's a lot of rocks to turn over. It's a lot of frogs to kiss, I guess. And we're super picky. So we know what we're looking for, and when we find it, we strike. But we have a lot of demand for capital to be placed, and we just don't have a deal for them to place it in right now. So it's a nice place to be, Craig, that we're not forced to buy real estate. We only buy it if we love it.
Yeah, that makes sense. And I guess, on that end, just for anyone, the biggest risk you really associate to a deal can oftentimes be takeover risk, meaning you buy an asset, now it's yours. You don't know what the broker or the past seller was feeding you. Once it's yours, you look under the hood, you may not like it, and you may struggle to turn over ownership and stuff like that. And it's a very scary thing that you have to consider with any acquisition. How disruptive is it potentially to a new tenant? Particularly if the management team goes away, if the other team's using a third-party management and they're not allowing you to hire there, or if the property and the team's vertically integrated and that team is doing a great job, and then you buy it, the tenants may fall in love with that leasing agent, and that owner, that operator, may not allow you and probably won't allow you to interview their on-site team because they want to keep their talent, because good talent is incredibly hard to find. So those are the risks you have to look at any acquisition. So I do appreciate kind of that long-term mindset. And what I'm kind of hearing you say too is, it sounds like you maybe do some form or version of maybe a crystallization. Do you kind of set up your structures where you're acquiring them and then doing a cash out refinance of sort, with kind of the property there, and then hold it longer? What if you bought a property today that you loved? What would you have as a plan there? Would you hold it, refi it, return capital, and then kind of have some sort of cash flow promote shared structure. Can you maybe walk us through that maybe?
Yeah, so we're probably a little different than most sponsors out there because we used to do funds and now we've moved back to just a single direct investment. So each asset has to stand on its own, has its own business plan, it's got its own tax strategy, and typically there's only, 6 to 12 investors involved. So we like to keep them, where their check sizes are similar and they think similarly. So typically our objective is buy the property, reposition it in the first 3 to 5 years, and then do a refinance there. Or if we put agency debt on it, then we're going to add the supplemental right there. Use those proceeds to return capital, and then we're just going to keep the coupon. So at every one of the refinance events in the future, we'll offer liquidity. So if anybody wants to get out, they're still going to have the opportunity to get out.
So maybe you could structure around, because you have fewer investors, you could structure around for need's sake ownership and things of that nature with the refinance potentially.
Yeah. Yes, exactly.
And is that why you probably want to keep a smaller bucket of investors for that purpose?
Not really, but it actually was not our design. It was designed by our LPs. So we used to have funds. Well, we still do have funds. And the LPs of greater capability approached us. And this is, when we began to see a pattern, we said, okay, hold on, let's do this. And we just ran a test model. And for the most part, they were fighting over spots in line to get into a single deal. And it was because they eventually would like to have all of their capital returned and still own the coupon and never pay the tax. It's
the best way to do real estate, quite frankly.
Yeah.
That's actually how real estate is done by rich people. Is they buy it and they hold it eventually. I mean, they refinance it and do that 8 ways to Sunday, but they never really liquidate the property to have it recaptured.
Yeah, and they never pay the capital gains either.
No.
So, I mean, I think really you hit the nail on the head. We're offering rich people the way to do real estate the way it's supposed to be done. We're just the machine or the engine behind it that does all the work.
Yeah. Now, our goal eventually at some point when we're a little more seasoned and tenured is to do more with less investors, refinance the deals. Because if you're clipping deals, we've got an asset in particular, or several assets that we really love, but there's several deals that we want to own indefinitely. Now, there are going to be points in the market, like right now, for instance, where you're going to be acquiring deals because the basis is just too juicy, right? The deals that are frankly struggling the most in our space are probably that B and below space, that are not collecting as well, that may have some sort of financial distress. They may have, a unique opportunity where you could, buy a deal that's has leasing problems with terrible management. Well, some of those deals are what you call more of the hot potato space, where, hey, it just means to an end. There's a clear path to progress. You can make a lot of money on these, but you don't really want to own that area. Versus there's some assets where it's, really an A area or B plus area, and kind of like a B plus A minus property that you'd want to hold all the time. You love the area, you love the management. You can't build more supply there. Who wouldn't want to own there forever, right? So different assets have different kind of theses, particularly in the apartment space, especially when there's not as much of a moat and NIMBYism, which is, for those who don't know what that NIMBYism phrase is, it means not in my backyard. That NIMBYism where they don't really want to, you can just create more in our space. You can't really do that in yours.
That's right.
So can you you go.
Go ahead. No, we got about 10 minutes left and I have to jump.
So no problem.
Make sure that let's make sure we cover what you wanted to cover.
Yeah, no, with that said, I guess, why are they not making, and I know this might sound silly, but why are they not making more mobile home parks, and why is there such an issue there? Is it cities that are struggling? Can you enlighten us?
It's just economics. So when you think about the difference between, and let's use the example of like a 30-acre piece of land, and let's just look at a major city like Phoenix. On that 30 acres with 10 units per acre density, you get 300 mobile home lots. Minus some common amenities and whatnot, maybe you get 250 lots, right? The tax revenue that is going to be collected from the city is going to be on the lot rent, which is $500 to $700, depending on the quality of that mobile home park. Now you put an apartment there, same 30 acres, 3 or 4 stories. your density is 4 to 5x, and you're going vertical. Then you start to add, instead of it being $500 to $700 a month for lot rent, it's $2 to $3,000 in monthly. Well, we'll call it 2,500 maybe in monthly apartment rent. So the tax revenue for the city is 20x or greater, same piece of dirt. Now you look at the expense side for a city, and they have to offer to all of the residents on that property, fire, schools, police, all of those services. They'll actually spend more than they'll collect on the mobile home park. It's a losing proposition for them. So although I think at the core, like, take greed out of it and say, if you approach any city official that actually really cares, they would like to see more affordable housing built
on their
problem
terms.
is they won't want to do it and lose money in the process. So I think the only way that mobile home parks get built is when that dynamic is not present. That typically happens in the outskirts, in the bedroom communities around a city. So you got to drive 50 miles because the land's cheaper out there, and it starts to work. The challenge that you run into on those is now you don't have the utility solutions that you otherwise would have in town. So the cost to build those utility solutions they kill the deal. So, I know all the guys in the space that focus on the development side. Most of the development is done in Texas. It's very favorable. Texas is bullish on manufactured housing, so they're more favorable than other states or municipalities. And then there's demand there. The population in Texas is growing like wildfire. So you can go right outside of a city and put in your own private utilities, and it still works. So it's just extremely difficult to get the approvals from cities. If you tried to, there's been one mobile home park built in the last, there's two. One's kind of RV, so it's a little bit of a cheat, up near Flagstaff that was built, 300 lots or so. And then one in Verde Valley, like halfway between here and Flagstaff, there was a mobile home park that was built. That's it. No other mobile home parks have been built here since I've been in the business.
There's been more than 2 apartment complexes that have gone live in Phoenix in the last couple of years, for those who are wondering. And that's why you see 2 months, 3 months, 4 month free in concessions. So I say that joking.
Craig, there's probably more than 2 that have been coming online in the last 2 weeks.
I think during our podcast 2 got delivered. No, Phoenix is a hotbed for it. Austin just had 15% of the supply hit. Phoenix is ground zero as well for multifamily supply. But the great thing is that what you're talking about really isn't affected there. We got to wrap up here because you got to go soon. Jack, I really appreciate your time. And just for those who are listening, if you're looking to get in this space, you probably want to work with people who don't need your dollars to do deals. That's the sign of a healthy company and someone who's doing it right. And Jack kind of is that guy. So maybe you can get on Jack's good list and bribe him of sorts, whatever works there. But Jack, if people want to learn about your thesis, working with a 5210, how can they get a hold of you to learn more about yourself and your product and your offerings?
Best way is to go to our website. It's 5210.com, and that's the number 52, TEN. So the 10 is spelled out, .com.
Excellent. Jack, thank you very much for being a wealth of insight. I hope to have you on in the future to talk about the latest and greatest within the space, discuss the trends, and something I'm really not privy to. For those who are listening this week, we appreciate your time, and we'll see you next week.
Thank you, Craig.